Well, I think the market's been struggling with the same things that it's grappled with all year, which is a monetary policy direction that's not completely clear. As you know, the odds of a December cut have really jumped around from as high as 60 down to 30, back to 80. And the second is, of course, policy volatility, because the administration does make proclamations and statements that are sometimes head fakes but confuse investors, and it's all resulted in really suppressed enthusiasm for stocks. Sentiment has been bearish. We know people lost money they've de-risked. This was 5 years of history compressed into 1 year, because we had a major bear market, the biggest tariff hikes ever. But miraculously, stocks went into a waterfall decline and recovered every single point of that decline symmetrically. I think we're set up for a really strong rally into year-end.
Crypto investors are on edge, wondering if Bitcoin and Ethereum are due for another pullback in the coming weeks. Yet the cycle keeps heating up, and Tom Lee is still calling for a parabolic run into the final month of 2025. While there's forced selling and leveraged bets, it's what we expect whenever an asset nears a massive ceiling. Zoom out though, and the picture changes. Analysts are spotting a historical pattern. Ethereum today is having its Bitcoin 2017 moment, when it soared past $1,000 and finally forced Wall Street to pay attention. Just as Bitcoin did then, Ethereum is now drawing in institutions, hedge funds, asset managers, and heavyweight investors who see use cases far beyond speculation. Meanwhile, Bitcoin has been behaving like a high beta risk asset, and if markets recover, it could rip higher alongside them. If the tape stays indecisive, short-term pressure remains a risk. Price-wise, Bitcoin sits just over $91,000, still down over 20% in the past month. On the ground, the community is buzzing and adoption is spreading, from DeFi rails to stablecoin infrastructure. Even regulation may be tilting in Ethereum's favor. That shifts ETH from just another coin to a potential backbone for tomorrow's financial future. And as Tom Lee points out, this is likely just the beginning. With Wall Street's deeper involvement and retail energy still strong, Ethereum's growth story has room to run. The question now isn't if Ethereum will climb higher, but how fast it can write the next chapter in crypto history. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
We know it's kind of an upside bias the Wednesday before Thanksgiving and the Friday after. But beyond that, where do we go?
I think we're set up for a really strong rally into year-end. And I know we just came out of a pretty terrible grind. I've talked to a lot of PMs that have said it's one of their worst 6-week periods ever in their career. So we know people lost money they've de-risked. But we know into year-end we have the positive seasonals, especially given how strong the May to October was. It's really a 5 to 6 chance that we're going to be up 5% into year end.
Right.
The second is monetary policy, I think, is going to shift dovish. Even if Fed Chair Powell is hawkish, we know it waiting in the wings is now a shadow Fed that's dovish. The third is we know sentiment is going to have to chase this rally because 80% of fund managers are trailing their benchmark. And then I think the fundamental story is pretty intact. As we're doing work into next year, and I think earnings visibility is going to be really good. So I don't think I'm questioning if earnings are peaking. It's more just that stocks price in and correct enough.
Now, you've been, I think, pointing toward, let's say, 7,000 in the S&P by year end. Now, that's only like 2.5% up from here. We made some progress. What might you think about in terms of impediments looking into 2026?
Yes, we're almost through this year, and I'd say looking back, this was 5 years of history compressed into 1 year, because we had a major bear market, the biggest tariff hikes ever. But miraculously, stocks went into a waterfall decline and recovered every single point of that decline symmetrically. So it really speaks to the resilience. But I guess as we're thinking about next year, I bet you it's going to be very similar in the sense that we'll get a policy shock, maybe whether it's monetary or from the administration. It could lead to a big drawdown of 20% again.
Yeah.
But it's a replay of this year. And maybe we've now had 20% bear markets in 5 years. That's a lot of history compressed into a 5-year period.
What role did the violent shakeout in crypto have on all that? Because a week ago, That's all we were talking about, was Bitcoin can't stop going down. The NASDAQ wants to follow it, or people are concerned about how that's going to knock other things loose in other financial assets. So it's stabilized, but it's not exactly sort of participating to the upside in this bounce.
Yes. So crypto had been a leading indicator for actually most of the last 5 years. But on October 10th, crypto had what I would call Armageddon, a flash event, but it led to a liquidation that was never seen in the 15 years history of Bitcoin. About a third of the market makers went out of business that day. Almost 2 million accounts went to zero.
Yeah.
And it was because of a pricing error, what I would call a glitch. It led to what they call auto deleveraging.
You've definitely made that case that it definitely seems as if there was something in the kind of market maker functioning that got fouled. Yeah. Now, that being said, the reason you can have all those accounts auto-liquidated is because there were that many accounts with that much leverage that got Bitcoin up to where it was, above 120.
Yes.
Right? I mean, so it's not as if it happened in a vacuum.
Yeah. So in a way, it means crypto represents really a very precise measurement of risk appetite, because there's so much more leverage. And that got wiped out.
Right.
That last time it happened in 2022, it took 8 weeks before people sort of touch their toes back in. I think that's where we are. We're near a bottom. But now I don't think crypto leads. Crypto is lagging, because I think it's still very likely that Bitcoin's going to be above 100,000 before year end, and maybe even above one to a new high. So Bitcoin makes its moves in 10 days and every year. I think some of those best days are still going to happen before year end. I know stocks have been sort of trading pole position, NVIDIA and Alphabet. But to me, the bigger story arc remains that AI is a mega trend. There's a lot of resources and spending, and it's a big contributor to growth. And we know there's a shortage of both power and silicon. So I do think it's going to ultimately move in the next 12 months kind of as one cohort. I don't think valuation sensitivity is as important as people think. We're actually studying this now. We're going to be publishing it soon. But if you look back 10 years ago, the most expensive stocks at the end of 2015 continue to be the best stocks over the next 5 years.
I don't even know if it's really a valuation story in terms of what's taken a step back. It's a matter of who's got the current lead. Whose
model
or the
works
clearest
better.
path or something like that. Yeah.
Ethereum isn't just holding its ground, it's starting to pull ahead. As 2025 winds down, Ethereum has actually outperformed most other major crypto assets, driven by record on-chain activity, surging developer adoption, and growing institutional demand. While Bitcoin continues to anchor the market, Ethereum's momentum is signaling that it could be a real leader in this next phase, setting the stage for what analysts call its strongest run yet. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
I think we're in a very different place. That was post. Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor. in crypto, we know it's, market makers play a big role, but there's someone that is probably capital constrained or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level. That is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold. So that a stock or crypto no longer falls on bad news.
Cameron, in terms of the macro, I mean, everyone has been able to say, okay, we had this rhetorical dovish pivot from Fed members. We can now price in a cut. You mentioned that it looks like we have a glide path toward 3% in short-term rates. Are those still going to be insurance cuts? Are those still going to be like the economy doesn't really need it, but we could use it? Because we just had the Beige Book come out, and there was a lot of commentary about softness in labor markets and companies finding ways to do more with fewer people.
Yeah, that is the biggest question, because cutting because you can is a very different story for risk assets than cutting because you should. If the context of the cuts is because the labor market needs the support, that the economy needs the support, what you would see within things like equities or credit is a lot of weakness, because equity valuations would be too high and earnings estimates would be too high. But if you're cutting because you're just trying to get to neutral because you don't want to be too tight in the future, that's when equities can very much rally and enjoy it. Now, the Beige Book has been painting a very sour picture about the economy for quite some time, as has all soft data been painting a much more sour picture about the economy. So we continue to go back to this notion of what is the equity market telling us about things like the U.S. consumer. Equal weight discretionary versus staples is still in an uptrend. So to us, the equity market is still arguing that the aggregate consumer, of course, with big weights to high-income consumers, is still in a fairly good position. So we'll continue to monitor that for any kind of change.
Yeah. I mean, I do think that the outright inability of staples companies to actually perform is helping that. But you're right. In a real recessionary scenario, those stocks would probably start to work again. We mentioned, I guess, what's happening in terms of the Fed, which feeds into yields. The 10-year down below 10%. I was just looking earlier. The 60-40 portfolio total return has actually kept pace with the S&P on a year-to-date basis. Where are you thinking about those types of allocations, and what are you telling clients in terms of the fixed income side?
It's so nice to finally be rewarded with attractive yields on the fixed income side. To us, fixed income is one of those, it's the steadfast, it's the ballast, it's to protect against the unexpected. And so particularly if you're able to be high quality in terms of focusing on whether it's treasuries or corporates and stay kind of intermediate duration, that to us is more appropriate. But as I said, it's really just nice to see cautious investors no longer punished.
Where does all of this leave us? Ethereum has crossed $4,000, weathered short-term volatility, and is now attracting the kind of institutional attention that once catapulted Bitcoin into the mainstream. Analysts are increasingly framing this as Ethereum's 2017 Bitcoin moment, where the groundwork laid over the past decade finally meets global recognition and capital inflows. But here's what makes this cycle different. Ethereum isn't just competing as a digital currency. It's the infrastructure powering decentralized finance, stablecoins, and entire ecosystems of applications that regulators and institutions are beginning to take seriously. That combination of utility and adoption is exactly why many see $5,000 and beyond as not just a price target, but an inevitable milestone. Over the past year, Ethereum has quietly outperformed most other major crypto assets. Tom Lee and other top analysts emphasize this point. Ethereum's real growth story is still ahead of us. With Wall Street leaning in, developers innovating faster than ever, and adoption spreading across industries, Ethereum is positioned to be a defining force as we head into 2026. The bottom line: the short-term swings may grab headlines, but the long-term trajectory is unmistakable. Ethereum is evolving from a promising blockchain into a cornerstone of digital finance and technology, and if history is any guide, the breakout we're seeing now could be just the opening chapter of Ethereum's biggest run yet.